Transmile Group founder and former CEO Gan Boon Aun has been found guilty for his role in the chartered air freight operators accounting scandal. Sessions Court Judge Hasbullah Adam found Gan guilty on an alternative charge of furnishing, as the director of Transmile and with intent to deceive, a misleading statement to Bursa Malaysia with regard to the quarterly report on unaudited consolidated results for FY06. Gan was fined 2.5 million ringgit and sentenced to 1 day in jail. The verdict comes after 10 years of court proceedings. Transmile was once the country's national cargo carrier and a darling stock whose investors included business tycoon Robert Kwok and Post Malaysia. It was initially listed on the second board of Bursa in 1997 before it was transferred to the main board in 2002. The company fell from grace in 2007 after it was revealed that its stellar performance in 2006 was but a sham due to massive accounting irregularities. After a tumultuous chain of events, the company was categorized as a Practice Note 17 company in 2010. It was eventually suspended and delisted from Bursa in 2011. Former Finance Minister Lim Guan Eng says Pakatan Harapan dished out 352 million ringgit out of the 6.61 billion ringgit worth of government procurements awarded via direct negotiations during its administration. According to reports, the DAP Sekjen said the balance 6.258 billion ringgit were inherited from BN and that PH had no choice but to proceed with them. Lim reportedly cited as an example Phase 2 of the Klang Valley Double Tracking Project, which BN had awarded via direct negotiations to Daya Maju Ltat for approximately 5.26 billion ringgit. He said PH had decided to cancel the contract. But after both Daya Maju and Ltat appealed to Putrajaya, the PH government decided to proceed with the project, albeit at a lower cost of 4.475 billion ringgit. As for the 352 million ringgit projects that were directly awarded during PH's tenure, Lim reportedly said some of them were applied by Housing Minister Zuraida Kamarudin, who has remained on the job after defecting to the PN administration. On the 21,000 ringgit purchase of books that were available online for free by the Economic Affairs Ministry, Lim said the blame lies with then Minister Datuk Sri Muhammad Azmin Ali. Yesterday, Lim's successor, Tengku Datuk Sri Zafrul Abdul Aziz, made public the list of 101 government procurements that were awarded via direct negotiations during PH's tenure. Zafrul said today that he released the list in the name of transparency. He also stressed that conducting direct negotiations for government projects is not against the law and that the issue should not be politicized. Maybank says its second quarter earnings halved to 941.73 million ringgit, hit by pandemic-related restrictions and interest rate cuts across most of its regional markets. The lender saw its net interest income and Islamic banking income shrink by 8.2% to 3.95 billion ringgit. Meanwhile, allowances for impairment losses on loans, advances, financing and other debts spiked by a whopping 344% to 1.74 billion ringgit amid an outlook darkened by the COVID-19 outbreak. Quarterly revenue fell by 9.7% to 11.79 billion ringgit. As for the first half of FY20, cumulative net profit fell 20% to 2.99 billion ringgit, while revenue inched 3.9% lower to 25.01 billion ringgit. It did not propose any interim dividend, citing the need to prioritize capital and liquidity preservation amid the fluidity of the current environment owing to the pandemic. Looking ahead, Maybank is expecting softer loan growth and a compression in net interest margin. The group also sees loan loss provisioning staying elevated. It revised its headline KPI for return on equity to about 7.5% for FY20. Telekom Malaysia posted a 141% jump in second quarter net profit due to the absence of impairment loss on fixed network assets recorded previously. Earnings rose to 274.75 million ringgit from 114.18 million ringgit. Revenue, however, fell 6.4% to 2.59 billion ringgit, following the price adjustments to its Streamix service and as the MCO restricted economic activities. For the cumulative 6 months, the telco operator recorded a 1.1% increase in net profit to 427.27 million ringgit, although revenue was down 7.2% at 5.15 billion ringgit. TM declared an interim single-tier dividend of 6.8 cents per share. On its prospects, the group aims to maintain business profitability for the coming quarters of 2020. CEO Imri Mokhtar says TM will continue to actively evaluate various ways to meet its performance targets whilst optimizing costs and capex across its operations. He says the group has started to arrest the decline and is positive that its cost optimization initiatives will continue to bear fruit, translating into positive margins. Sime Darby says fourth quarter net profit dipped 3.8% to 177 million ringgit, due largely to the impairment of assets and the adverse impact of the coronavirus outbreak, with its motors division bearing the brunt. Quarterly revenue came in 5.4% lower at 8.82 billion ringgit. It declared a special 1 cent dividend and a 7 cent second interim dividend. For the full year ended June 30th, the group's net profit was down 13.5% year-on-year to 820 million ringgit, despite revenue increasing 2.2% to 36.93 billion ringgit. The weaker earnings were mainly due to the recognition of a deferred tax credit of 129 million ringgit arising from the change in real property gains tax rates in Malaysia in the previous financial year. Meanwhile, Sime Darby plantation turned in a sharply higher profit for the second quarter as stronger palm oil prices offset a slump in demand, particularly in Europe. Net profit stood at 378 million ringgit versus 27 million ringgit a year earlier, while its top line improved by 12% to 3.22 billion ringgit. Its net profit for the first 6 months of its fiscal year spiked to 846 million ringgit from 101 million ringgit. Cumulative revenue came in 6.8% higher at 6.26 billion ringgit. The group declared an interim dividend of 2.57 cents per share and a special interim dividend of 1.45 cents per share.